In this video, we will talk about financial statements. We will start with the balance sheet. The balance sheet, as you may recall from your previous accounting classes, will have your assets on one side. It will be divided between current assets and sometimes called long-term assets or fixed assets. You see here how they say tangible and intangible. And current assets is typically split between cash, accounts receivable, and inventories. Now, those are your typical three listed in the order of liquidity, but you may see other items in there like marketable securities and some other highly liquid short-term stuff. Now, then on the right-hand side is where you typically see current liabilities and long-term debt. Those two combined will be your total liabilities. And then equity, your shareholders' equity on the side. What you're seeing here in the middle, net working capital, it's that gap between your current assets and your current liabilities. So when you do current assets minus current liabilities, the difference is your net working capital. A few items to talk about the balance sheet. Net working capital, as mentioned, current assets minus current liabilities, usually positive for a healthy firm. Of course, you want to have more assets than liabilities, but from time to time, and depending on the type of operations you run, it could be negative, but it doesn't mean that something really bad is going on. It could be just part of the cycle, the cash cycle of the company, many other things, but usually positive. You want to always aim for that. Liquidity, speed and ease of conversion to cash without significant loss of value. Now, that second part is important. How fast can you sell something or convert it to cash is the key thing. But if you're going to lose a lot of value, then it's not that liquid. Meaning, if somebody was to sell their house, it can take some time to find a suitable buyer, get the right amount of money that it's worth, etc. But you could sell your house the same day with a cash offer for $10. You will lose a lot of value, but it will sell really fast. So the speed is there, but without the loss of value is not there. So a house is not that liquid. And that's always important. The speed is alone doesn't tell you it's liquid. It had to be fast or how fast without losing value. Valuable in avoiding financial distress. So if things start going bad for a little bit of time, you need to be able to have access to cash to cover those harder times in the business. Then we go to the debt versus equity side. That is your liabilities and your equity in the balance sheet. The same way that assets equals liabilities plus equity, then equity equals assets minus liability. Now, market versus book value. This is very important in finance. So book value, the balance sheet value of the assets, liabilities, and equity. So as the company moves forward in time, the income statement happens, then that will change your balance sheet. And then your cash flows will reflect what happened throughout that period as well. But the point is that these, as they say, is book value. Now, that's different from market value because that's what the people value it and are willing to pay for it as a company. So to kind of simplify that, book value can give you the value of equity, of shareholders' equity, based on those cycles and how the money comes in and out. Market value is more like your stock price, what people think the company is worth, and it could be more or less than the book value. It just depends how they're valuing the company moving forward, what they think is going to happen. And That's why you see where it says market value, the true value, because really you can put a price on something, but the true value is what somebody's willing to pay for it. You can do all kinds of calculations, estimations. Oh, it depreciates and this is worth this and blah, blah. But at the end of the day, it doesn't matter what valuation is given. The true value is what somebody's willing to pay for it. And that's where the market value comes in. So it doesn't matter what your books say. It could be completely accurate and fine, but if people are not willing to pay for it at that level, the stock price will be lower, the market value, or the stock price could be higher if they have good expectations for the company moving forward. Market value and book value are often very different. Why? Well, what I explained, what the actual accounting process and the flow of the net income, retained earnings, etc., versus what people are willing to pay for it. Which is more important to the decision-making process? Well, it's not that the book value is not important, because you have to keep this accounting process showing profitability, nice return on equity, and all that stuff. But at the end of the day, the one that dominates is the market value. That's the one that's more important because that's what really represents what the market is willing to pay for your company and your stocks and stuff like that. The income statement. The income statement, as you may recall, pretty much it takes the money that comes in, take out the expenses and costs, and how much did you keep? That's your net profit. In formal words, the net income statement measures performance over a specific period of time, whether it's a quarter, a year, whatever time frame. Typically every 3 months and once a year for the entire year. And it just shows how much money came in, what went out, how much you kept. Reports revenues first and then deduct any expenses for the period. End result, net income, also known as the bottom line. Then, after net income, you can choose to pay dividends to shareholders from the net income. Now, you don't have to, no company has to. Some do, some don't. But if they do, it's going to come out of the net income. So the net income has to be calculated first through the income statement in order to even decide the dividend payment and how much is going to go out. Now, let's say the net income was $100 and they paid $20 in dividends. That $80 left over is going to move into retained earnings in the balance sheet. So the process is revenue minus costs, expenses, etc., net income. From net income, you may or may not pay dividends. Whatever you do or don't, you're going to have some money left over. And that money left over is the retained earnings portion that goes into the balance sheet. The income statement equation in the simplest form, revenue minus expenses equals net income. The financial statements in general will follow the gap matching principle. Recognize revenue when it's fully earned. What does that mean? Let's say you fix the car for somebody, your mechanic. That's when you earned it. They may pay you later, and that's fine. That's a cash flow thing, but it is not a revenue thing. So you will recognize that revenue when it's earned, as in that money came in. Not that money came in, let me rephrase that. The money's earned, so I'm entitled to that money. Whether it comes in or not, that's a later discussion. That's for a different part. So if the person paid you on the spot, then you recognize the revenue at the same time that you receive the cash. That's fine. If the person, you agree with the person, they'll pay you next month. So yeah, your revenue is that much, but now that becomes an accounts receivable situation because you haven't received the cash. And that's how you that's where you record the difference between I earned the revenue, so it goes in my income statement. I have not received the cash, so it goes in accounts receivable. And it won't show in the statement of cash flows because the cash is not being in. Match expenses required to generate revenue to the period of recognition. So let's say you had to buy some parts to fix that car, but when you went to the store, you told them, hey, I'm going to pay you next month. So you also told them something similar. So that's an accounts payable situation. However, in the income statement, you have to write there as if the cost occurred. So you're going to say this much in parts and labor, etc. Even if you don't pay your mechanic, let's say it's you employ the mechanic, even you're not gonna give them their paycheck later, even though you're not gonna pay for the parts at the store until later, the cash has not moved hands, but you're still gonna write it in the income statement as in that cost and expense happened when I earned that revenue. Non-cash items, expenses charged against revenue that do not affect cash flow, literally what it says, non-cash items. So you will probably see these in income statements and balance sheet, but definitely not in the statement of cash flow. Cash has to move for it to show in the cash flow statement. Depreciation equals most important. Depreciation is an example of a non-cash item that we just explained. It shows on your balance sheet, it shows in your income statement as a cost or expense, but no cash is really moving. So it's not on the statement of cash flows. Depreciation equals most important. What they're saying here is that from all the non-cash items, depreciation is always the biggest one of them. So it always keeps on coming up and is definitely relevant for all kind of other calculations. Financial statements continued. Okay, time and costs. You got fixed or variable costs. To give you a refresher, the fixed costs are the ones that do not change whether you sell an item or not. Variable cost is the one that only applies when the item is sold because they only apply to the item and not the fixed stuff, like let's say you're building. Not obvious on the income statement. Well, caveat, because the income statement we're referring to here is the one with cost of goods sold. So what you will see in the income statement is sales or revenue, however they call it, and depending on the preference, minus cost of goods sold. And what happens is that cost of goods sold have a portion of variable cost in there and a portion of fixed cost in there, but it doesn't separate it, so it's not obvious on the income statement. However, you may have seen a different way to calculate the income statement where instead of cost of goods sold, they actually put sales minus variable cost equals contribution margin. And then further down, it will have the fixed cost. And that form of doing the income statement, yes, you will see the variable cost and the fixed cost there. The other way, which is the one that's typically for reporting, this will say sales minus cost of goods sold equals gross margin. So yes, that statement on the slide that you see on screen is correct, but only when you're doing cost of goods sold. If you're doing the other type of income statement, which is used for other different analysis internal, then yes, it will be clear. Earnings management, smoothing earnings. These are decisions that companies make to try to make the, I'm going to say it in a way that sounds like they're cheating, but it's not, where they're trying to make the income statement look better and the balance sheet look better. But it's just a matter of where you have flexibility, then you can record things according to that and still be within GAAP. And that's why they say GAAP leaves wiggle room because it's never going to be perfect. And as it can get really close to perfection, but they allow for some wiggle room. Plus, there are some areas where you have to make decisions. For example, when you have accounts receivable, if you have people that may not pay you or starting to, you can't collect, you may move those into allowance for doubtful accounts. How much you move there, it's kind of like a decision the company makes. There's no fixed number. And that can make a difference. That's one of the wiggle rooms, for example. that can then do, earnings management, smoothing earnings, etc. Global standardization of accounting. Well, that is still a big challenge. Companies are becoming more and more international. What happens is that every country has a different set of laws, a different set of tax code, a different way they recognize cost and revenues and how they can capitalize things, different depreciation schedules. It can get very, very messy in the senses that they're not the same. So there's this attempt and hard work to be able to try to get a more standardized accounting that still fits those differences in legal, tax, etc. And that's why you're saying GAAP versus IFRS. IFRS is the one trying to consolidate that. Um, every country is always going to have their own laws, and they may change from time to time, so it's a difficult task. Taxes, marginal versus average tax rates. Let me say up front, in accounting, they're always going to be doing the calculation of the marginal. We in finance will have to go through that, but because our intent is to get that average tax rate, so we can, or we also call it an effective tax rate, and it's so we can get the actual money that went out that is going to be paid in taxes. Marginal tax rate, as you move up the tiers, it changes the amount, the percentage that goes. So what we do is we take, okay, so how much did you pay in total after all the marginal calculations? Okay, divide that by the revenue. That's your average tax rate. And now we have a number we can go by that if we get a certain amount of revenue, we can expect this percentage to go out in taxes without having to calculate marginal every time. As you know, by definition, marginal is percent tax paid on the next dollar earned. As you earn more money, those higher dollars get taxed differently. Average is, as I mentioned, total taxes paid divided by taxable income. By default, your average tax rate should always be below your highest marginal tax rate. If considering a project that will increase taxable income by $1 million, which tax rate should you use in your analysis? Well, that can get tricky. Uh, the question is, if the $1 million is going to take you to the next marginal tax rate above, then you're going to have to recalculate how that tax is going to happen. Now, let's say you're already at the max highest marginal tax rate and you're not going to move anymore. So then you might want to use that highest marginal tax rate for that specific project. But when you throw everything in the company as a whole, you might then be using the average tax rate. However, the decision is made based on the information you're given. Cash flow, we're going to move into the concept of cash flow. Just what it sounds like is the movement of cash. Does it flow in the company or out the company? Cash flow equals one of the most important pieces of information that can be derived from financial statements. Now, here we go. So in accounting, they always spoke a lot about net income, retained earnings, equity, about and the ratios you did. Well, a lot of were about those, and they're important for those measures. However, in finance, the true value of anything becomes the actual cash, the cash movement. How much cash goes in, how much cash goes out, when does it come in, when does it go out, how much do you keep, and at the end of the day, a company goes bankrupt when they run out of cash, not when they have a negative net income. Now, if you have negative net income for so many years in a row, yeah, you're going to end up bankrupt. It is because more cash is going out than what is coming in. So eventually you will run out of cash and you go bankrupt. So in finance, we look at the cash to assign value or to estimate value. The accounting statement of cash flows does not provide the same information that we're interested in here. Um, True. So what we have to do is then find other ways to calculate the cash flow that we are interested in. We are going to talk about things like operating cash flow, free cash flows, and we'll get to that. Our focus, how cash is generated from utilizing assets and how does it pay to those who finance the asset purchase. So as you see, they are talking about cash in and cash out. There's more to it, but at the end of the day, how cash is generated, cash coming in, and how is it paid out to debt holders and shareholders, cash going out. Now, when we say cash coming in the generator part, you can look at it as all the cash that comes in and then take away the cash for the cost and expensive and how much cash you kept. So let's look at it from that angle. How much cash did you keep after you paid everything in revenue, your net income kind of approach? So it's not just the cash that came in, it's how much cash you kept. And then from that cash that you kept, how does it go out to pay the debt holders and the shareholders? All right, so these last three slides, starting here, we're going to go over some of the key formulas you need to know. Now, one thing that I'm going to say up front is what you're seeing on the screen right now is the same item that you're calculating, but with different pieces of information. They're both calculating the cash flow from assets. Down here, cash flow from assets. We're just letting you know that there's more than one way to get to that number. And it's going to, which way do you choose depends on the information you are provided. So if you can, from the data you have, given an exercise, if you can get operating cash flow and net capital spending and network, the change in net working capital, they can use those three, this minus this minus this, and that will leave you with a cash flow from assets. But let's say what they gave you as information is cash flow to creditors and cash flow to stockholders, then you can just add those two together and you get cash flow from assets. Now, they may give you information that are not exactly these, but information that you can use to get to these and then eventually end up in the cash flows from assets. So sometimes you have to build the pieces of information to get to what you need to get to. But understand that there's more than one way to get the number you need. Here, it's an example of the situation that I'm talking about. So if you do it from this approach, as we mentioned, cash flow from assets from the operating cash flow minus net capital spending minus change in net working capital. Well, notice that operating cash flow, they may not give it to you directly, but they may give you the EBIT, earnings before interest and taxes, depreciation, and the taxes. So let's say they gave you net capital spending and the information, they gave you change in net working capital, but they did not give you operating cash flow. But they did give you EBIT, depreciation, and taxes. So you can calculate that piece, get the number, put it here, and then calculate that. Same goes with these other two. They may not give you none of these, but they give you all these other ones: EBIT, depreciation, taxes, net ending net fixed assets, beginning depreciation. You would have it then again there. Ending net working capital minus beginning net working capital. Let's say they give you all these separate. Well, you can use those pieces of information to calculate these pieces of information, take those pieces of information, put it in here, and you have your cash flow from assets. So you're just going to have to check, what do I have that can calculate this? Same goes with this one here on the left. Cash flow to creditors, that's the bondholders plus cash flow to stockholders. If they give you these two pieces of information, you can get there. If they give you other pieces of information that you can calculate these, then you can build them and then get to there. This will be an example. The cash flow to creditors. Let's say they didn't give you that, right? So let's go back. So let's say they don't give you cash flow to creditors and they don't give you cash flow to stockholders, but they do give you interest paid, net new borrowing, and they do give you dividends paid, net new equity raised. So if you take interest paid minus net new borrowing, you can get cash flow to creditors. You take the dividends paid minus net new equity raised, and that will give you cash flow to stockholders. Once you have those two numbers, you can go back here, add them together, and you get cash flow from assets. And yes, for the same company, you will get the same number. Whether you go from this route or that route, this will end up being the same exact number. It's just a different way to get to the same place. That will do it for this video. See you on the next one.